Okay, now let's continue with the take on the bigger picture. For that, joining me now here at the big board is Russell Hackmann, president of Hackmann Wealth Partners, helping to set up the new year for us. So, you would think new year, new money on Wall Street, right? And where are the flows going and what are we watching? What's your thought for the setup of this year for 2026? Kevin was just talking about he sees a continuation of the trends.
Look, I think the positive trend, Diane, is well supported still. You've got positive earnings growth. You've got a Fed that's likely in cut mode, right? We've got the replacement of Chairman Powell coming up. So a fair amount of positive momentum. Normally don't fight the Fed. If the Fed's cutting rates, that's normally a good thing for the markets. On the other hand, there's a couple wild cards we're keeping our eyes out on. One is inflation, and we haven't had any sort of very clear inflation data for a couple months due to the government shutdown, so we'll keep an eye on that. Unemployment, GDP growth, midterm elections. There's going to be a lot to talk about this year.
I know.
Yeah.
I do think, and when I talk to other analysts, they have this view that this year will be a little bit more bumpy. Now, last year we had bumps, but it wasn't like throughout the whole year. There was a big one, like a giant pothole, basically. We recovered from that. And end of the day strong, or end of the year strong, right, with a double-digit advance, 16% for the S&P 500, extending the gains of more than 20% we saw the previous 2 years. Do you expect that kind of momentum to continue? Because I do see, generally speaking, there's this expectation we will have a gain this year in the S&P 500, but it's all over the place whether we'll see a double-digit percentage or on the lower end, like 3 to 5%, I've heard.
I was looking at some statistics about midterm election years, and fairly often those years are not so good, right? So we'll see about that. Typically the year after, which would be next year, is better. I think there can't help but be, given that there's these 7 or 10 stocks basically that dominate the market, and that when they move, the markets move big time. And there's so much shifting of sentiment depending on what day you're in, around AI, around chip deliveries, around the different LLM models and everything else, that you can't help think that there's going to be some big moves, throughout the year. And but beneath it all, there are some curveballs lurking on the private credit side. You've probably talked about that. So are there some sort of lending issues out in the economy that could come back and hit the stock market? We'll see.
How worried are you about private credit issues and the potential impact to equities?
Thus far, it seems pretty contained, but it's interesting, 2007, that seemed pretty contained at the time, too.
Until it wasn't.
I don't think it's intertwined throughout the financial system and leveraged up nearly as much as certainly the mortgage market was back then. Jamie Dimon was quoted, though, as saying a few weeks ago, hey, when you got one cockroach, which was this First Brand situation, that's usually not.
There's more.
There's usually more of that, right?
True.
So, there's going to be some issues there. I think there's been some. It seems like there's been some aggressive lending that goes back to COVID times. That, look, it could come around and bite us a little bit.
I'm looking at a heat map really quickly because you mentioned those, the 7 or the 10. When I look, for instance, at the Mag 7, most of them, 6 of the 7 in the red today. Right. Now, to be fair, this could be a thinner market still, given that we're still kind of in holiday mode. Yeah. What do you think when you see that?
Not too much for the first year, for the first day of the year, really. Not too much, meaning I think once you start getting some actual data and start seeing the real performance and some real milestones, there's this sort of shift of, are we in a bubble? Are we over-investing? Are we not? And I think that narrative's likely to shift several times throughout the year. And that's the market makers love that. They love to make things move, but it's it's hard, I think, for regular investors when you basically have 8 stocks doing it, doing everything.
All the heavy lifting, right? Let me go back to your point about inflation. The Fed's been really trying to get inflation to that 2% target for years now, honestly.
Right.
And they had to pivot and focus more on employment recently. Do you expect this year the focus will shift more back to inflation, or?
Well, the Fed really has, and part of it is the political winds blowing. The Fed has been basically saying, hey, sounded more focused on the labor market, even though the labor market is not terribly weak at all. Unemployment's still 4.6 or so. But on the other hand, as you were pointing out, the mandate is kind of get inflation to 2%. I haven't heard a lot of the Fed talking about that lately. And if you can't say that it's not possible that we might not get some 3% inflation numbers sometime soon. And I think that's an outside risk as well.
Okay, so that's an outside risk. Let's go back to the point about Fed chair change this year, right? We're expecting a new Fed chair. Given the expectation of kind of who's at the top of the list, do you expect more rate cuts than the Fed seems to be penciling in?
Well, certainly you think whoever gets that chair, that the president has tried to get whatever reassurance he can that that person is going to be an advocate of cuts. But, the Fed chair doesn't make that decision alone. And I think there are several board members that are concerned about inflation. And, I think if inflation is coming out at 2.9 or 3%, and actually in the GDP numbers that were out recently, if you looked at the PCE data, it was 2.8, 2.9. I mean, this is relatively high inflation unless you want to admit and say, hey, we'll just run it hot at 3%. And, the GDP number itself was 4% plus. Yeah. That's not all bad. But, I think that narrative needs to sort itself out around inflation.
I want to we mentioned coming into this that, it's all about the crystal ball right now. So what's your, top prediction for 2026?
Look, I think we're going to have some volatility. I think, you've got the market trading at 23, 24 times earnings. That's, a very high valuation. You've got so much concentration in tech, being 45% of the S&P. It's just a lot of concentration. Even as recently as 2022, you saw some of these big, Mag 7 stocks drop in half. Now, a lot of that was due to, interest rates went up in a hurry and inflation was very high. But, there's some fragility to the market, I would say. So, for our clients, for most of whom are retired or are in retirement, it's sort of control your risk to the market because it really is tied to technology, and that's a volatile area.
And for Meta, that led to the year of efficiency. We'll see if they end up going back to another year of efficiency.
Well, right. Yeah.
Indeed. All right, Russell, we'll have to leave our conversation there for today. That's Russell Hackmann. Thank you as well. That's Russell Hackmann, president of Hackmann Wealth Partners, and also author of Wall Street is Not Your Friend.